Hey there, lots of people hate taxes, and it seems unfair when you make small money and still need to pay lots of taxes while some rich dudes publicly saying they don't pay any taxes. Some rich dudes like Robert Kiyosaki and Donald Trump have openly talked about how they avoid paying taxes. And you might be wondering, how can they publicly talk about paying less taxes, maybe even less than you, or not paying at all, while we know that not paying taxes is illegal? Why doesn't the government do anything to make these rich people pay more taxes? And you might have heard about some people and companies who were arrested for not paying taxes, so what's the difference between those people and these rich dudes who publicly say they don't pay taxes? Well, rich people have smart ways to pay less or even no taxes at all. There are two main ways to avoid paying taxes: tax evasion and tax avoidance. Section 1. Tax evasion. Tax evasion, or tax fraud, is when people break the law by not paying the taxes they owe. This means lying to the government about how much money they made or hiding money so the government doesn't know about it. This is illegal and can get people into serious trouble. Let's break down how tax evasion works with some examples. The first trick is underreporting income. This means they tell the government they made less money than they actually did. Let's say Bob wants to buy a house from John for $700,000. If the tax rate is 10%, they would need to pay $70,000 in taxes. But to save money, Bob and John agree to lie about the price. Bob still pays John $700,000, but they tell the government the house was sold for only $500,000. This way, they only pay $50,000 in taxes instead of $70,000, saving $20,000. This is illegal because they are lying about the actual sale price to avoid paying the full tax amount. The second trick is hiding assets. This means people hide their money in places where the government can't easily find it. For example, in the past Switzerland was famous as a tax haven. A tax haven is a country with very low taxes and strict privacy laws, making it attractive for people to hide their money there. Usually, banks have to report information about their account holders to the government so that taxes can be calculated and collected properly. But Swiss banks were known for their secrecy and didn't share information about account holders with other countries' tax authorities. So, if a rich person puts their money in a Swiss bank account, their home country's government won't know about it. Here's how it works. Let's say Tom, an American, earns a lot of money but doesn't want to pay high taxes on it. So, Tom opens a bank account in Switzerland. Because Swiss banks keep this information secret, Tom doesn't report this money to the United States tax authorities, the IRS. By hiding his assets this way, Tom avoids paying taxes on this income. This is illegal because Tom is lying about where his money is and not reporting it to the tax authorities. However, this has changed as lots of countries began pressuring Switzerland to share information about account holders with tax authorities in their home countries. So, if a rich American hides his money in a Swiss account today, the bank would report this to the IRS and he would be arrested. The third trick is false deductions. This means people or businesses lie about their expenses, making them seem higher than they actually are to reduce their taxable income and pay less tax. For example, imagine Sarah owns a pizza restaurant and earns $100,000. If you have a business, the government allows you to reduce your tax burden to help your business grow by letting you spend your business income first, reducing the amount of taxable income. So, if Sarah earns $100,000, instead of directly taxing her 20% of $100,000, which is $20,000, the government lets her spend some of that money on her business first. If Sarah renovated her restaurant for $30,000, she'd only pay 20% on the remaining $70,000, which is $14,000. But Sarah wants to pay less tax and keep more money. So, she renovates her restaurant for only $3,000 but falsely claims she spent $30,000. This reduces her taxable income to $70,000. Now, she only pays 20% of $70,000, which is $14,000, plus her actual renovation cost of $3,000. Her total spending is $17,000. By inflating her expenses, she reduces her taxable income, pays less tax, and profiting $83,000. If she had been honest and spent the full $30,000 on renovation, her total spending would be $44,000 and just get $56,000 the rest. So, the point is Sarah, who should have spent $30,000 on renovation, just spent $3,000 on the renovation and corrupted the rest $27,000 but lied to IRS that she used the whole $30,000 to reduce her taxable income. In summary, tax evasion involves illegal methods that break the law and can get you into big trouble. So, it's really important to remember not to try these at home. However, there's a legal way to pay less in taxes, called tax avoidance. Section 2. Tax avoidance. Tax avoidance is about using smart, legal strategies to pay less in taxes. It's like finding little loopholes or taking advantage of tax deductions and credits that the law allows. While tax evasion can lead to fines or even jail time, tax avoidance is considered clever financial planning. So, instead of breaking the law, you're just using the rules to keep more of your money. Let's break down how tax avoidance works with some examples. The first trick is using controlled foreign corporations, or CFCs. A CFC is a company set up in another country where taxes are very low or even zero, known as a tax haven. By doing this, people can move their profits to this foreign company to avoid paying high taxes in their own country. A real-life example is Apple, the company that makes the iPhone and other electronic stuff. Apple avoided paying a huge amount of taxes, about $44 billion, in just 3 years from 2009 to 2012 by setting up shell companies. One of the first shell companies was called Apple Corporation Euro in Ireland. This company didn't have any employees, but it was incredibly beneficial for Apple. So, how does this shell company work? Ireland's tax laws recognize a company's tax residency based on where the company's management is controlled. On the other hand, U.S. tax laws recognize tax residency based on where the company is incorporated. Apple took advantage of this difference. By creating a company in Ireland, the U.S. didn't tax the company because it was incorporated in Ireland. Additionally, by having management control in the U.S. instead of Ireland, Apple avoided Irish taxes. The second trick is transfer pricing. Transfer pricing is when a company moves money between its branches in different countries. It sets prices for things like products or services to make profits show up in places with low taxes. This way, the company pays less tax overall. For example, let's say John has a company named Wee Shoes Corporation in the United States. His company just sold a new model of shoes and made $1 million in income. Let's assume the U.S. corporate tax rate is 35%. Normally, he would pay $350,000 in tax and keep $650,000 in profit. But instead of paying this 35% tax, John decides to use a tax haven like the Cayman Islands, which has 0% corporate tax. So, John sets up a subsidiary in the Cayman Islands called Wee Shoes Cayman Islands Corporation and transfers all the Wee Shoes Corporation's patents and copyrights to this subsidiary. When the U.S. Wee Shoes Corporation sells a new model of shoes and makes $1 million, it claims it needs to pay $800,000 to the Cayman Islands subsidiary for using the Wee brand's patents and intellectual property. This leaves only $200,000 in the U.S. to be taxed at 35%. So, the company only pays $70,000 in U.S. taxes and no taxes in the Cayman Islands, keeping $930,000 in profit after taxes. This saves John $280,000 in taxes. However, John can't bring this $800,000 from the Cayman Islands back to the U.S. without paying taxes on it. So, what would John do? John can reinvest the money outside the U.S. or wait for tax reform. For example, in 2018, the U.S. corporate tax rate changed from 35% to 21%. If that happens again, John can bring the money back to the U.S. at the lower tax rate. If John decides to bring back the $800,000 at the new 21% tax rate, he would pay $168,000 in taxes, keeping $632,000. This way, John ends up with $762,000 after taxes, compared to $650,000 if he had paid the initial 35% tax. The third trick is using dividends. As I mentioned before, Warren Buffett, one of the most successful investors, pays a lower tax rate than his secretary. How does this happen? Well, because his income mainly comes from dividends and long-term capital gains, not salary. Dividends and long-term capital gains are taxed at lower rates compared to ordinary income. For instance, while a $100,000 salary might face a tax rate of 22% to 24%, $100,000 in qualified dividends and capital gains is taxed at just 15%. This tax advantage allows Buffett and other wealthy people to pay less in taxes on their income from investments, which are treated more favorably by tax laws. In summary, tax evasion is illegally avoiding taxes by lying or hiding money, while tax avoidance is using legal methods to reduce or even avoid tax bills. While tax evasion is risky and illegal, tax avoidance can be a smart way to handle your finances within the law and provide benefits. It's also important to note that some strategies people think are tax avoidance are actually tax deferral. Tax deferral means you are just delaying tax payments but still need to pay the same amount eventually. For example, contributing to 401k retirement accounts, using 1031 exchanges for real estate, IRA, and others. These strategies delay taxes to a later time, unlike tax avoidance, which aims to reduce the overall tax bill. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.